When people talk about silver and gold manipulation, I remember back to the decade of the 70s, where trading desks manipulated the price of gold and silver up. Manipulation occurs in all markets, and the manipulators generally try to profit on the difference in scope and scale between the physical market and the futures market. The futures market being much larger, much more leveraged, and very prone to outsized moves as a consequence of moves in the physical market. Therefore, if you're trying to profit on a down move in silver, you would build a ladder in the silver futures markets and then use a physical position, probably borrowed, to sell overnight during the period of time when the market is the least liquid to generate the most downward momentum in silver in the short term so that you could cover your futures positions as they reacted to what happens in the futures market.
Did you know that manipulation occurs in all markets, including precious metals? In the 1970s, trading desks manipulated the price of gold and silver to profit from differences between the physical and futures markets. Rick Rule reveals a chilling strategy still used today. Traders who want to profit from a decline in silver build futures market positions and then borrow physical silver to sell during the least liquid times. This generates maximum downward momentum, allowing them to cover their futures positions as prices react. This isn't just a conspiracy theory. It's a tactic that has been in play for decades. The implications for investors are profound. As we navigate an era where the financial landscape is shifting, understanding these manipulative practices is crucial. Imagine investing in a market where hidden forces can dramatically sway prices overnight. This isn't a relic of the past, it's happening now. Rick Rule suggests that we could see a significant shift, where future manipulations might favor long positions rather than short ones. This means potential volatility and uncertainty in precious metals markets like never before.
It is true that the current bull market in gold has largely been a function of foreign central bank buying. But I think the price escalation in non-US dollar terms, which has been extraordinary, and the more recent price escalation in US dollar terms, has created the momentum that has established gold as at least a legitimate topic of discussion among institutions. It's important to note that institutions' perceptions, like the perceptions of individual investors, has been formed, at least recently, over the last 40 years, in a market that's probably the most benign financial market in recorded history. The period 1982, after the breaking of the inflation of the 1970s, to 2022, world peace, globalization, the hegemony of the US dollar, declining interest rates. A complete Goldilocks scenario. Nobody was afraid of anything. They didn't have any reason to be afraid of anything. Even in periodic moments of illiquidity, the 1987 debacle, the 2008 liquidity squeeze, the lesson that was learned was buy the dips. My suspicion is that epoch ended in 2022. Clearly, there is a hiatus in the process of world peace. Clearly, there's less globalization. Clearly, the demographics around the baby boomers coming of age is past us from an economic sense. And clearly, too, the period of declining interest rates is over. In addition to that, one thing that we don't notice is the fact that the growth of government, which we were able to afford over 40 years, is over. It doesn't mean the government won't keep growing, but our ability to afford it is coming to a screeching halt. So a combination of all those things, I think, will force institutions towards more precious metals ownership. Young people without much experience, some education, but no money, giving advice to the rest of the world. And that seems to be a particularly odd phenomenon. I've met a lot of financial journalists in my time from big news organizations, and while they struck me as being well-meaning people, they didn't strike me as being people that I would like to trust my money with. But the truth is that they do set the paradigm for many people. The institutional investor is different, but I need to say that the institutional investor is a person, and that person was schooled in the most benign economic climate known to man. The anticipation of the future is always set by the experience in the immediate past, and the experience in the immediate past was good. But let's think about an experienced portfolio manager. Let's just for fun say that Dunnigan Kaiser as opposed to being a podcaster, is responsible for, let's say he runs the University of Florida endowment. And this money is coming in, and it needs to be sequestered in a way that will provide for the well-being of students of Florida 30 years from now. Now, for the last 40 years, he's invested in long bonds because that's been pretty sure and pretty steady. Now he has a circumstance with a portfolio of long bonds where if interest rate goes up, he gets screwed because the capitalized value of the distribution of the long bonds is worth less today. If interest rates and bond yields go down, he's screwed too, because the interest that he receives on those bonds won't be sufficient to compensate for the reduction in purchasing power that endowment will face 20 or 30 years from now. So his leading asset class, which is to say long bonds, the asset class which has made his reputation and saved the university, suddenly is challenged. Where is he going to go? Well, I suspect one place he's going to go, if he's any student of history at all, is an instrument that has fulfilled the function of portfolio insurance against inflation. I'm not suggesting, by the way, that Dunnigan Kaiser, Chancellor of the University of Florida, is going to jettison his entire long bond portfolio and put all the money into precious metals. What I am suggesting is that by rebalancing a little bit of his own portfolio or the University of Florida's portfolio, he's going to work profound change. And here's the statistic around that. The percentage of the market share of precious metals relative to other savings and investment asset classes in the United States is less than 0.5%. The 4-decade mean is 2%. If Dunnigan Kaiser, Chancellor of the University of Florida, reduces his bond portfolio by an eyelash and uses some portion of that eyelash to insure his bond portfolio, we will undergo a massive change in asset allocation in the United States. And that's precisely what I think is going to happen. I think about my former employer, Sprott Inc., and we worked very hard in my tenure there to develop institutional clientele, both in the United States and elsewhere. And my former colleagues, the people who still work there, tell me every day about the impact that those efforts have had. Their deep penetration into the U.S. Insurance and endowment market, their deep penetration into foreign sovereign wealth funds. What we're talking about occurring is occurring. It isn't, it will occur. It is occurring, and it's occurring as we speak. I think they're missing perhaps two things. First of all, the silver buyer is more a greed buyer, a momentum buyer, focused on unbridled upside. The gold buyer is a fear buyer, a very, very different buyer. The second thing that, well, I think that's probably enough, actually. The motivations for buying gold and buying silver are often very different. The other thing I would say is I'm not certain why the ratio between gold and silver has any validity as an investment consideration. The fact that silver is 16 times more prevalent in the Earth's surface doesn't go to very much to their relative utility. Both have some utility as a monetary metal, but gold would seem to have deeper utility as a monetary metal. Both have some utility in commercial applications, but silver would seem to have more in commercial applications. Further, with regards to silver, the speculator needs to understand that to understand the future supply of silver, since so much of it is produced as an adjunct of the production of, say, copper, lead, and zinc, that you have no idea what the supply is going to be like 5 years from now. It'll depend on copper production, lead production, or zinc production. So I think that the equation is much more nuanced than the questioner presented. The genesis of the Sprott Physical Copper Trust was our institutional investors who have enjoyed our precious metals trust and our uranium trust asking if we could create a liquid exchange-traded vehicle for copper. It was as simple as that. The market came to us and said, can you guys construct a product where it will be exchange-traded where it will be liquid and where the storage and transfer fees are low enough that it is affordable. This is really a circumstance where the market came to us and said, we will buy this product if you will create it. I think no doubt that the extraordinary success of the Sprott Physical Uranium Trust is what caused the institutional investor around the world to say to Sprott, we need you to create a series of publicly listed liquid commodity trusts in addition to precious metals and uranium. Markets are bigger than politicians. When people talk about silver and gold manipulation, I remember back to the decade of the 70s, where trading desks manipulated the price of gold and silver up. Manipulation occurs in all markets, and the manipulators generally try to profit on the difference in scope and scale between the physical market and the futures market. The futures market being much larger, much more leveraged, and very prone to outsized moves as a consequence of moves in the physical market. Therefore, if you're trying to profit on a down move in silver, you would build a ladder in the silver futures markets and then use a physical position, probably borrowed, to sell overnight during the period of time when the market is the least liquid to generate the most downward momentum in silver in the short term so that you could cover your futures positions as they reacted to what happens in the futures market. That exact same strategy happened in the decade of the 70s from a long point of view. The markets are manipulated in whatever direction the manipulators think will be easy to move. I wouldn't confuse yourself in the silver market by thinking that there was a 4-decade-long conspiracy to depress the price of silver. They didn't have to do that because the market did it. The US dollar was strong. You don't need to work really hard to cause something to decline that's going to decline of its own volition. I believe in 2022 that whole circumstance changed, and I believe at some point in the future that the short-term manipulation that happens in precious metals markets will be from the long, not the short side.